People are going to lose their minds. This is a moment in history unlike anything humanity's gone through. It's a very different world for humans to come.
Take a step back and see the broad picture, which is the way all these technologies are interlinked.
Because this is all about exponentiality, and humans can't think in exponential terms.
How consequential do you want to say machine intelligence is? It's almost certainly as consequential as writing. How long did writing take to disseminate through the human population? Hundreds, thousands of years. And we're dealing with it now on a scale of months.
But in this kind of world, you're compounding 100% growth every year, and the numbers become astronomical.
AI is going to spot patterns in the world that were just completely invisible to us.
Even if you think that the AI and the robots are your demise, you might as well bloody invest in them and make some money out of it. If not, you're just going to be angry man shaking your fists at the clouds.
What are the impacts of higher for longer? Welcome to Real Vision Daily Briefing. It's Wednesday, November 8th, 2023. I'm Ash Bennington. I'm joined today by George Goncalves, head of U.S. macro strategy at MUFG. George, welcome back to Real Vision Daily Briefing.
Thanks, Ash. Pleasure to be with you.
It's a pleasure to be with you too. First time the two of us are on this show together. I'm excited to dive in and get started. Look, we teased it a little bit at the top of the show, asking about the impacts of higher for longer. All eyes right now on price and inflation data, global central bank policy, and financial conditions. George, big picture, where do you see us right now at the 50,000-foot level?
Well, Ash, I'm old school, trained by some of the best global macro strategists, economists over the years, and worked at some really great places and interact with clients all the time. So I really get to benefit from hearing what's going on throughout the system. And and for me, there's really three things that always matter. Rates still matter. I mean, there's this kind of notion that rates don't matter. I mean, I think we conveniently forget that it takes a time to show up for rates to actually impact the economy, and markets are impatient by nature. And that at the end of the day, everything is priced on the margin, right? Like that's true for housing, it's true for for stocks, it's true for even bonds, right? So I think on the margin, everything gets set, and ultimately, liquidity rules the day. It rules the trading day, and so those are the three things that kind of really guide me throughout the daily, weekly kind of in and outs of the markets. The bigger picture standing out. I mean, I think look, we have we're late cycle in many different ways, but this cycle has been so altered based on the starting point, and especially coming out of the pandemic and all this sort of stimulus, and the way that the Fed reacted, it took long, and now it's probably going to take long to go the other way. And I think that unfortunately, it's going to end up with unnecessary macro vol, and people are just getting used to it, and they're not really, they don't like this sort of volatility. They don't understand it, and it's still reverberating through the system. And I think it's going to take a while before we really figure out, can we get a soft landing? Is it a bumpy landing, but we avoid a recession? Or is it truly going to be like a kind of a harder drop in? And then we know that given past experience, they're probably going to try to come in for the rescue with a lot of stimulus and or Fed easing. But we have that kind of difficulty that next year is an election year. So I'm of the view that it's going to get tougher before it gets better. And people don't like that message. But the good news is that we'll get through it, and then we'll be able to really discern where were the malinvestments, where is there really opportunities, and where's value. And I think that it's still too early to say that for both risk assets, for fixed income, especially on the leverage side. Like, I mean, there's still a lot of kind of stones to be turned over.
Well, we're going to get to your base case in just a second, but I want to ask you this because it's something that you touch on in your most recent research note for MUFG. And it's this question, what are the things that seems to happen? Like, we as human beings seem to tune out things that get repeated again and again and again, like, please return your tray to its full upright position, right? You start to lose the ability to understand it or to perceive it. And one of the things that Jay Powell has always said is this phrase, long and variable lags, when talking about the way that monetary policy has a transmission mechanism to the broader economy, and of course, also to risk asset prices. How do you think about that in relation to where we are right now?
Yeah, I mean, that is the trillion-dollar question, because this idea that, we can handle higher rates, and that I'm just saying collectively speaking for the marketplace, and that there's pricing power and it's equally distributed, and that every company is going to be able to live through this higher environment, and it's going to be virtuous. I mean, that's like the Goldilocks super optimistic outcome that we can now somehow afford high rates. Meanwhile, what's kind of in the background forming and developing is those long and variable lags, and it's going to expose those that cannot afford for this to persist for long periods of time. But yet we're being told that higher for longer is going to be the regime that we're in. That's why we dub it a paradox, because the longer you're in it, it's going to expose those weaknesses eventually. But the faster you get out of it, we'll never really know the counterfactual. And so this is where it really gets tricky, because I don't think push comes to shove, if we start seeing weakness in the economy, and if it really gets to the labor market quickly, the Fed's going to pivot so quick, and so markets know that. So they're like, CRE, people wanting to refi their house or wait to get into a home in the first place. Everyone's, oh yeah, the Fed's going to pivot, so I'm just going to wait. And so it's creating this kind of tension, which eventually has to give way.
Yeah, so let me ask you this. What's your base case? What's the probability distribution look like in your mind as we head forward?
So our view, we've been flirting between 60 to 75% chance of a recession over the next 12 months. And it could very well be at our doorsteps right now, right? So there's given last week's payroll, I think that was a much more honest picture of what's truly going on in the labor market. So I think in the coming months into the first half of next year, I think we're going to get, really get that impact of those long and variable lags. We're going to see that there's less rate of change benefit from fiscal spending. All that's behind us, not ahead of us. And I think it's going to hit really hard. So our base case is that we're either at this kind of precipice of the recession, or some really, really weak economic activity throughout the first half of next year.
Yeah. So the base case is basically it's going to catch up with us. The hikes are going to eventually kick in. We're going to see more likely than not. I mean, 75% chance of recession, fairly high.
Absolutely. I mean, look, that's as far as I can go. The other alternative case is that they somehow manage to catch it, but then they open up the other more negative outcome, which I think is actually worse than a recession, which will be the kind of perpetual stagflation. So this is why I think that they want to try to stay higher for longer, and then be able to cut quick and avoid a deep recession, but not necessarily trigger inflation or those inflation expectations. So you kind of have to feel some of that pain to realize that you get some disinflationary, potentially deflationary shocks in certain industries. And then that will then take pressure off inflation. So they don't have to cut back to zero. Maybe they cut hard, 100 basis points quick, and then see if it works. And if it doesn't, they cut another 100 basis points. And that can very well happen throughout the course of 2024. And they avoid going back to zero, because they don't want to necessarily create another asset bubble either, right? So this is kind of their own dilemma that they're fighting with.
Yeah, let's talk a little bit about price levels, because we're truly in sort of unprecedented territory here when you think about the context, the past being prologue. When you see inflation just collapse, obviously, with the pandemic, then you get this massive monetary easing and this huge spring back, then obviously substantial declines from peak on CPI, PCE, pick your indicator. But how do you think about that now? I mean, are we in a period where it's just very hard to gauge whether prices are in fact truly normalizing, or if we're going to have something that looks, I don't know, maybe 150, 250 basis points elevated above where they want to be? I mean, is that problem that lasts, like when you jump out of a plane and your parachute doesn't open, the first 15,000 feet are fine, but it's the last 6 inches that kill you?
Oh, that's a really kind of morbid comparison, but I do think it's really hard to tell that last mile, right? You don't know where you're at, the last few inches, whatever it may be. You don't know where you're at, and I think we're in that ambiguous state right now. That's true for policymakers and for markets, and then that leads to less conviction on the part of traders and portfolio managers, and policymakers are just hoping for the best and hoping that they're going to get their glide path down towards their 2% target. But while we're waiting, it's a very uncomfortable position to be in, because 3 is still elevated, but it's better than 9. And the question then becomes, does 3 become a springboard back to 6, right? And that's what really gets people nervous. And then because it's the second wave that really gets you the permanent higher inflation expectations. It's the second wave. So this big first wave that we had in 2020 through 21 to early 22, like that's basically behind us now. A lot of it was supply chain driven, and a lot of it just fixed itself on its own, and really didn't really require, in my opinion, this much in terms of hikes. I think they overshot by at least 100, if not more. So now we're going to, even if they ease 100, I think it's still going to be tight at 4%, 4.5%. And so, like, if they kind of gradually take down rates over the course of next year, it won't be enough to really create a soft landing. So they would have to be aggressive, in my view.
Yeah, I mean, it's sort of strange. You have this weird effect that you had on the forward rate path where you had prices of hikes being priced in when inflation was too hot, and then prices being baked in that it's going to get cut. 6 months further along the line. It's a weird sort of moment, right? I mean, we're past that now, but it was a strange moment when it happened.
Sure, and a lot of it was just insurance policies taken out just as a worst case scenario. And it was really, a lot of it still earlier in the year during the throes of the regional bank crisis, which in my mind is still an issue out there, right? So it was understandable why they were taking place and why we're seeing those deep inversions. But we all know, and it's been well documented on your shows and everybody else and everything that we've written, it's the disinversion that gets you, right? So that, if once we start to really properly disinvert, then you're counting the weeks and months before the real acknowledgement of the weakness in the economy.
Yeah, I'll play devil's advocate here. Obviously, yes, 3 or 3.7 is better than 9. But when you have this persistent elevated inflation, the specter that you raised earlier, which is a long period of stagflation, is a risk, a non-zero risk at very least.
That's right, and that's why we've been conditioned in a way where, well, if it gets bad enough, the Fed has our back, and therefore they're going to ease and they're going to eventually come back to QE, which we don't buy that argument. But the hurdle for super accommodative Fed is very high. They're going to try to avoid at all costs creating those conditions again. And so they'll just drag their feet. They might be punchy at first and take down rates 100 basis points and see if that's enough to actually stabilize, the growth side of the equation. Because if they're cutting, it's because they're worried about growth in the jobs market. Something happened, right? And or if something happens financially, right? But if we're kind of in this holding pattern, which it looks like we are, then they're going to avoid doing that, because if you get it wrong, the risk is it's a non-0% chance you're going to flip back up towards 6-7% inflation, and then that's when you get that really sticky mindset amongst the consumer, and it's really hard to break that, and they know it.
So let's talk a little bit more about financial conditions. Obviously, one of the things that we've been hearing is this idea that the 10-year yield is essentially trimming the sails of the economy for you. I think maybe that's an optimistic way of thinking about it. But talk a little bit about what we've seen at the belly of the curve, rising rates there, and the impact to the broader economy.
So all these things, even that operates with a lag as well, right? So we're recording 1 week after the last FOMC, which feels like it was a month ago, because the price action, both risk assets and the bond market, have completely flipped, and we've got more favorable financial conditions as a result of the rally, both in stocks as well as a decline in rates out the curve. But just thinking about what took us up to that point last week, we had rates close to 5%, almost across the curve at certain points. And I think that matters. And I think that both putting off home purchase decisions and how that filters through the economy, just any sort of kind of holding back on coming to market with deals. I mean, I think that mattered. Now, I think the 450 on the 10-year to 5% range should be where we settle in. Much further than that, and basically where we are right now as of the time of the close, I think the market's kind of run too fast, too quickly, both on position adjustments and just a euphoria that the Fed has done. I think they are, but we shouldn't just get ahead of ourselves either. But based on that 455% range, that's still a lot of decent financial conditions tightening, which is going to prevent some of the more interest rate sensitive sectors of the economy to benefit until they actually do start cutting. So as long as we're between 450 and 5%, I think then that's still tightening, even though it's not going to be as bad at 5. But I think we'll kind of fluctuate in between there. A move under 450 means something is broken, right? So I think if we really get under 450, the Fed's not signaling they're going to cut. They actually came out in the last 2 days really pushing back hard on the rates market and saying, look, we don't understand. We didn't give a green light for cuts here. We're going to hold the line and higher for longer. So I think that means there's a give and take. And they could play with stuff during the December meeting. We think they're done, but they could get hawkish again and stay hawkish all throughout December, and then at the meeting signal that they're, those two cuts that we thought we were going to do in 2024, we're going to take those out. So like that's the way that they can kind of try to push back on the market a little bit. I think it's going to be a game of them proving that they're on hold.
Yeah, this sort of the jawboning effect, right? Where it's, well, this is a hawkish pause.
Yeah, I think like right now we've skipped twice, and if they skip again in December, then we can move towards calling it a proper pause, and then the clock started in July, right? So that they can be cutting rates March, May, June. That's fair game based on history.
Yeah, and by the way, 40 basis points on a yield basis decline off the highs on the 10-year yield of some 14 days or so.
Yeah, absolutely. So like, yeah, it's decent, and I think that they're not going to want to encourage it.
No. Let me talk just a little bit here, shift gear to some things that we've been discussing here on Real Vision, just so folks know. Obviously, we're on YouTube, and we have a whole platform for people to explore. And I just want to highlight some of these points. Talking about this, we had an incredible day of content here at Real Vision, beginning with trading macro themes with Andreas Steno-Larsen and Alex Campbell. Also, I did a conversation on Real Vision Pro Crypto with Sergey Nazarov, co-founder of Chainlink, where we talk about the merging of the traditional finance system as well as the blockchain space. So it's an interesting one there. And if you get a chance, I highly recommend taking a listen to our X Spaces out today, which I hosted with Raoul Pal and David Matten. You can find a recorded version of that on our website at app.realvision.com. That's app.realvision.com. George, let me ask you this. What are the gauges that you're going to be looking at on your screen as you try to interpret what happens next? In other words, what are the numbers, the levels that you have your eyes pointed on to see what might be breaking in terms of your thesis?
Sure. So I think it comes down to the jobs market, the continuing claims, which we get tomorrow. I think if you look at the unemployed, although the unemployment rate is only up about 0.5% or so from the bottom, it's going in the wrong direction. Number one, but that is a total of 1 million people that are out of work during that time frame. So if we once we start getting to the 4 handles on the unemployment rate, then we're clearly turned the corner. I think the claims data, both the weekly corroborating the continuing claims, which has been a little bit disconnected, but I think that will probably start kind of right itself in Q1, and unfortunately to the downside or to much more unemployed. And I do think that there's going to be quirks in the inflation data because of the way things are kind of calculated. So there's actually some upside risk for next week inflation, which could pop up rates again, and that might be another opportunity to think about looking at fixed income. But I do think that we're in a broader range. We don't have enough definitive information to draw a kind of conclusion of we should start a rally now before the Fed has even cut rates yet. It's going to be hard because the carry matters still. At some point, if they dig in their heels for 2, 3, 4 months, even 6 months before, you're going to lose a lot of carry just being short. So I do think that that's going to constrain the ability of rates to rally until they actually give us the go-ahead and actually do the first move and cut. So yeah, this is a holding pattern. This is a range trading world. In the past, that would be like a vol killer, right? Like vol would come down. But because positioning gets lighter and smaller into year end, and after such a tough year, let's be honest, this has been a really difficult year again for fixed income investors and macro investors in general, that smaller positions and more trading might create the bad vol where you're getting chopped up in both directions.
George, I'm pleased to say we've got a lot of questions coming in, and they're all right in your wheelhouse about macro and fixed income. First one comes to us from Scott Larson. And Scott wants to know, how does George feel about the broken 40-year downtrend in 10-year yield? What seems like a reasonable bottom in yields if we get and he does this in double quotes, mild recession? But first to the first point, George, obviously anybody who's been watching that chart of 10-year yield knows that it peaked in 1982 and it's basically rolled down until whatever it was, July, August of 2020. Give us a sense of what that means from a big picture perspective as you see it.
Look, I mean, that's close to 40 years and 25 years of my career through that time period. I mean, yeah. I always knew lower lows, right? So lower lows were always like that, rates are always going to rally. So you're always going to get a chance to kind of get straight on your positioning if you hold off for long enough. I think that the fact that lower lows are no longer with us and we're going to see lower highs and then probably end up in a bigger range trading environment again. So, for me, like the criteria, especially last year, is once we had like 2 or 3 quarters well above that 3 standard deviation downward channel. I know it's a chart that Raul uses a lot. I use it as well. That kind of standard deviation of that big channel. It got broken. You have to admit it. It's over. So that bond bull cycle did end last year. So now going forward doesn't mean that a bear market starts either. Like everyone wants to view that the opposite has to happen because we've had it for 40 years on a down cycle. I think Japan in that sense actually kind of gives us a little bit of a roadmap that we're probably going to see bigger range trading. And if it really, really got out of control, I mean, at some point even the Fed might have to go to YCC. So I think you call it the range 2.5% to 5%. The days of going back to 0 or 50 basis points on the 10-year, I mean, it would really be a really bad world, and I don't think we're there. I think that we're going to have this either mild recession or a bumpy bottom. The Fed's going to react, and then in 2025, 26, hopefully the world's a better place, and we have a more virtuous growth cycle, and that might get rates between 3 and 5.
George, I got to ask a follow-up there because you slid it in real fast. You said a throwaway line, Fed might go to YCC. What do you think the odds are of that actually happening? Yield curve control, of course.
I mean, look, they did it during World War II, right? So they did a version of it during World War II. It really depends on what's the motivating factor. And depends on if rates are kind of running away from us, right? I don't think that we're anywhere near that, but I do believe it's part of the tools that the Fed possesses, and I think it would be something, if need be, would be put into place. And actually, as we saw in Japan, actually you end up using less QE. You end up doing less because the market kind of respects the levels up to a certain point. So I do think that it's a tool. I don't think it's anywhere near being used, but if they don't get inflation right in the second wave, and if it were to come back with a vengeance, I think that's where the real trouble kicks in.
So what does that mean? 10% probability, 20% probability, less, more?
I think 5 to 10. It's low right now. I think it's still pretty low. Okay. I think they use rate cuts first. Yeah.
Here's a question from TrillionX Macro. George, what do you think that we are heading into a stagflation period rather than a recession, and therefore gold, not bonds, is the anti-fragile asset? So TrillionX asking about the relative weighting from a portfolio allocation perspective of gold versus bonds.
And look, that's a great question. And I think this is one of the reasons why a lot of fixed income investors have moved down the curve just to kind of reduce their duration risk, and either bills are paying off enough, and 1 to 3 year sector is good enough, especially in the IG sector with a little bit of spread. So I do think that gold does play a key role here, because the opportunity or the paths out there are so divergent that there's a lot of things that can happen that can either go wrong or right, and therefore, especially on the inflation front, that I do think that having the gold fits part of that high quality liquid asset part, even though it might not be liquid when you need it at that moment, but I think it's going to be part of that kind of foundation for any sort of portfolio.
Here's another good macro question about fixed income. Ralph Humphrey asks, has the TLT found a bottom? This is iShares 20-year plus Treasury bond ETF.
Look, well, I mean, given the ranges I gave earlier, 4.50%, 5%, that's maybe 5.25 or higher on the 30-year. I mean, if we break above that, then something has completely changed, because we were fretting all this past summer the additional supply, and supply is going to be with us, as long as we run deficits, which is going to be the case as far as we know it, and therefore, 5.25 in this instance probably should be. I think we'll be the top. I don't think we're going to break through that given the macro conditions that I envision happening. And I also think that risk markets are going to have a hard time staying in a good place at 5.25. So either way, it's going to be a governing factor that will prevent it from hopefully breaking above 5.25. So I mean, in short, I mean, I think we're kind of building a bottom here, but I still want to see another retest of that 5.25 before I say that it's finally the time to go long duration.
Well, here's a great question from Marty F. George stated he learned as old school. Are there any relationships that have fallen apart given their current situation? Boy, what a great question. Any old correlations that you're seeing break down, George?
I mean, there's obviously the way that FX vol and rate vol haven't been really working the same way as before. I think like the commodities part is now like, it's almost like let's put you have to compartmentalize. There's various versions of old school, like maybe the last 10, 20 years versus the last 50 years, right? Maybe we're going back to that 1970s stagflationary environment, and then you have to look at those correlations, right, and think about that, right? So I think it's all about the context of like what regime you think you're in. But I think the commodities coming back, and the which we've been all documenting, the 60-40 portfolio probably is no longer going to work, right? Especially in this environment until we get stability in inflation expectations, and volatility has to come off. We cannot have this sort of market that's always jumping around.
Bonito asks, George, with 33 trillion in debt and a ton of it in short duration, exactly how long can the Treasury stand higher for longer? And just another great question.
So that's why you kind of have to entertain the idea that YCC always could be out there. We have to start terming out our debt, but do you want to term out your debt at 5% or at 3%? I mean, next year, if I'm right on our rate call, and if it does start cutting rates, then that will give a reprieve to the Treasury, and they'll be able to finance at a much more favorable level from the Treasury standpoint. So I think rolling over these trillions of dollars of debt that we have to, and also locking it in, like on T-bills, it's fine because if they roll off and next year rates are at 3, then you save 200 basis points instantaneously, right? So I think that's why like they're going to try to hold off on locking in all of their funding at these levels of rates, because if I'm right on the macro and what the Fed's reaction function is, they're going to have a chance to actually lower the interest costs for the country, because at 5% plus, we can't afford it.
Okay, this one comes from Ralph Humphrey. What are these new rules the SEC has for clearing U.S. Treasury trades?
Yeah, those are still in the works, and we'll talk about it when they kind of come to fruition.
Fair enough. Boris Jurcik. Hi, George. Is there any connection between the USD and inflation rate? If yes, how would a considerably weaker US dollar play out? Might that develop into a problem?
So, I mean, look, I'm sure you've had it. We've all discussed it. I mean, there's more than just $1, so we have to be careful about that. I really do believe in that we have an onshore dollar versus an offshore dollar, like a lot of other countries have. And so it's the dollar, I think, is driven more by the need for the dollar more so than the macro factors, until again we get to the margin, which is relative to other pairs like the euro, the yen. So I think that at the margin, if something starts to kind of break on the dollar, then I think the correlations will get stronger towards inflation, and that could be detrimental to the dollar if we get higher inflation, if you get into this vicious loop in dollar weakness. But I think we're far from that. I think, in fact, now we're still combating the problem that we've had for many years of just a dollar shortage, and that is, that's going to be independent of what's happening in inflation, I think.
Okay, Bonito got another question. The question is, George, do you think the government / Treasury is going to try and manage the debt through inflation? Obviously, a big picture policy question.
Look, we had financial repression and negative real rates in the last decade or so, right? So in many ways, that was the tool of preference through that time period. I think first things first is getting that inflation number back down to a more manageable level. But if they have difficulties of getting it, pinning it at 2, and it fluctuates, as we discussed, Ash, earlier, between 2 and 4, then that's one way of going about it. I don't think they're going to try to manage it that way. I think that it's just an outcome of what we're dealing with right now. I don't think it's an expressed desired policy of both the Treasury or the Fed yet.
George, great questions, all very much in your wheelhouse. I know you got to jump here in just a second, but I want to give you an opportunity. Final thoughts, key takeaways that you want to leave our audience with.
Look, I'll just say, be mindful of liquidity for both the bond market and this sort of FX liquidity into year end. I think that there's a lot of still twists and turns ahead, and that it's been a rough year, and people might start to kind of square up positioning throughout the holidays. And so I just be mindful of liquidity and trade accordingly.
George, thanks so much for joining us.
Thank you. Thanks for having me.
Thanks everyone for watching or listening to the Real Vision Daily Briefing. Before we go, we have a great offer showing the power of the Real Vision community in action. Genesis NFT holder Major Duffels has helped secure thousands of dollars worth of tickets to Australia's largest crypto convention. It's all happening in Melbourne, Australia next weekend. The convention is hosted by the Australian Crypto Convention from November 11th through November 12th. Only available for the first 50 visionaries who register at realvision.com/Australia. That's realvision.com/Australia. We'll be back on the Real Vision Daily Briefing tomorrow. In the meantime, check out the Real Vision website where we share knowledge and tools for your financial success. Have a great afternoon, everybody.
People are going to lose their minds. This is a moment in history unlike anything humanity's gone through. It's a very different world for humans to come.
Take a step back and see the broad picture, which is the way all these technologies are interlinked.
Because this is all about exponentiality, and humans can't think in exponential terms.
How consequential do you want to say machine intelligence is? It's almost certainly as consequential as writing. How long did writing take to disseminate through the human population? Hundreds, thousands of years. And we're dealing with it now on a scale of months.
But in this kind of world, you're compounding 100% growth every year, and the numbers become astronomical.
AI is going to spot patterns in the world that were just completely invisible to us.
Even if you think that the AI and the robots are your demise, you might as well bloody invest in them and make some money out of it. If not, you're just going to be angry man shaking your fists at the clouds.